right, welcome back, everybody. Hope you had a good spring break.
I had an excellent spring break, but I'm sick. I'll be right back.
So, it's been a while. We have two new chapters. What we were looking at just when we started spring break at the last class. So we have chapters 17 and 18, which is about pooled investments or institutional investing. So we're looking at different types of funds, really, is normally how we'd say it. We have mutual funds, hedge funds, pension funds, and then there's really all sorts of different types of mutual funds. But that's what we're going to be looking at in this chapter. This chapter kind of bridges between financial markets that we had before and the financial institutions that we have now. So funds are technically institutions, but what they do is they trade in financial markets. So it really links the two together. And some of this stuff, a lot of funds are traded on exchanges, and so we already looked at some of them a bit in the previous couple of chapters. So it's going to repeat some of that stuff, but with a bit different perspective. The first thing that I wanted to go back to, though, is you remember back in the very first practice assignment that we had, practice assignment 1. We go to solutions. There was some data from, I think it was from the U.S. Census, actually, and from the U.S. Federal Reserve, which showed who owns all the different securities that are out there in U.S. financial markets. It was this data here, table 1166, from the flow of funds from the Federal Reserve. Doesn't matter where it was from, though. But what we had was, somewhere here we had a graph that we made from it. This graph is what I was looking for, which shows which type of institutions own all the securities that are out there in U.S. financial markets. And let me make this a bit bigger so we can see who they are. But for the remainder of the semester, really, we're going to be looking at different types of institutions. And now that we've looked at all the different markets out there, so we know what kind of securities there are, it's useful to look at the different institutions to see how sort of big they are in terms of how much of these securities that are traded, how much are owned by these different institutions. Now, if we go back to this graph that we had back here, it kind of gives you an idea about the main holders, who actually owns the securities that we've looked at that are being traded in the markets. And you got households and institutions, or households and charities here at 31%. They're the largest one. So in the U.S. especially, we don't actually have, a lot of the underlying holdings are done by individual people. And with charities, that would mean charitable endowments. So universities have endowments, and they hold a lot of assets. So that would include like university endowments and other charitable endowments. They're the biggest single holder. But after them, we got the rest of the world, foreigners. They own U.S. securities. We have non-financial businesses. So that's just other types of corporations for the most part, but not banks or financial corporations. And then over here, we got mutual funds, and we got pension funds. And together, that's 15%. So if we put those two classes together, that would be the number 2 group that holds securities in the U.S. So after households and charities, the next largest group that actually owns all these securities in U.S. financial markets, it would be these funds, these different types of funds. And most of these funds then are owned by individuals. So it's just an indirect way that individuals own securities. So they are very large in the financial markets in terms of owning a real large proportion of the securities that we have out there. Now, they are somewhat larger in the U.S. than they are elsewhere in the world. If this was elsewhere in the world, we would have a smaller amount for the different types of funds, and we'd have larger amounts basically for commercial banks and for insurance companies and for the government. The U.S. government owns very few securities in the U.S., and in foreign countries that's not always the case. Governments are big owners of securities in other countries. Okay, so that's kind of what we're going to be looking at here. So what I want to start with is a bit what we mean when we talk about these different types of funds. So what a fund is, and my smartboard works again, so I can scribble stuff. So funds just mean pooled investments. And by pooled investment, we mean instead of an individual person buying a security on their own, it's when a bunch of people bunch of people combine their money, so they put their money together. So it's kind of got I guess, three components to make something a fund or a pooled investment. First of all, it's more than one person. So you got a bunch of people combining their money together, so that's why we say it's pooled. Then they hire a professional manager, so a professional fund manager. So the people don't decide on their own what securities that fund is going to buy. There's some type of professional manager who's hired to make those decisions. And then together they invest in securities. And the fund, you can have different ways to classify the funds. The main way they're classified is what type of securities they invest in. So the main distinction would be you have stock funds, you have bond funds, funds that buy stocks and funds that buy bonds. You can also have there's all sorts of mixed funds that buy both stocks and bonds. And then you can have funds that buy any other type of security that we've looked at. Funds can buy derivatives, although there are some restrictions on what types of funds can buy derivatives. Funds can buy domestic securities or foreign securities. They can buy money market securities. So there's all types of different securities they can invest in, and a lot of that sort of gives you a classification on what the different types of funds are. First of all, what types of securities they might be. And the other way to classify the different types of funds is kind of by their organizational structure, how they're set up, and basically how they're regulated. And there's a lot of overlap here, actually, because first of all, funds can invest in other funds. So for example, pension funds are just any funds that save for people's retirement. And usually pension funds have some kind of tax treatment. Like when you put money into a pension fund, you don't have to pay any taxes on that money. Like if it comes from your salary, you don't have to pay income tax on that salary. It goes direct into the pension fund. And then you pay taxes on it usually when you retire and when you withdraw the money. That's the main way that the tax savings work for pension funds. And the exact details of that, it differs based on a couple different tax laws and different retirement plans. You've got some where you can be taxed first, then you put the money in, and whatever profits or whatever capital gains it gets are untaxed. Or you can put the money in without paying income tax on it, and then you get taxed on it when you withdraw the money. And there's different combinations. Depends if it's a 401k, if it's traditional, Roth. There's different laws, and there's a whole bunch of different variations on it. But all of them have the same idea that at some point in the stage, you either contribute money to the fund or you withdraw money from the fund without paying as much taxes as you otherwise would. And it's not a tax accounting class, so we won't go into all the details of that. But that's the idea with pension funds. Now, pension funds are managed collectively, so you got a bunch of different people putting their money together. So again, there's usually a professional manager, and pension funds can either then be invested in other funds, like a mutual fund, or directly in some types of securities, like stocks or bonds. So it does overlap with the other funds a bit. Then you got the mutual funds. And mutual funds is just really what fits the definition there of a pooled fund. Mutual funds are types of funds that are subject to certain U.S. law, at least in the U.S., and so we call them mutual funds. In other countries, you'll have the same types of pooled investments, but they won't necessarily be called mutual funds. They might go by another name. They can be called trusts or units or collective funds. There's a lot of different names, and kind of every country has a slightly different name, because exactly how they're classified depends on each country's law. In the U.S., we call them mutual funds. And so a lot of times pension funds are invested with mutual funds, so it overlaps between the two, but they don't have to be. And there's different types of mutual funds then. You've got open-end funds, and we'll come back to the details of each of these. And some of these we've looked at already a little bit. There's four main types of mutual funds: open-end funds, closed-end funds, exchange-traded funds, and unit investment trust. And we'll come back to the distinction between each of them. Open-end funds are by far the largest class, and they dominate it. Closed-end funds used to be dominant, but they have declined drastically, and now they're just a very small amount of overall assets in the fund business. Exchange-traded funds are the fastest growing type, and they're growing rapidly. Unit investment trusts are very small, very obscure, not really all that important, and probably just pretend they don't exist for the most part. In addition to these types of funds, some other types of funds that we have another class of funds which is quite varied, and over the time, the meaning of this term hedge funds has changed drastically, especially in the last decade or so. Hedge funds went through a little bit of a boom, and they got really popular and trendy, and the name started taking on very new meanings. Basically, any fund that people thought was cool and trendy started to get to be called a hedge fund, whether or not it had anything to do with what traditional hedge funds used to be or not. So now there's a whole class of other funds that we call hedge funds, and for the most part, these are kind of like the private equity equivalent of mutual funds, where mutual funds are public, meaning anybody in the public can go buy a mutual fund. Hedge funds are private funds that usually you have to be a wealthy individual to buy a hedge fund. Now there's kind of hedge funds for the people too that anybody can buy, but they're kind of like a private version of mutual funds. I'd say that's, but again, there's many different types of hedge funds with many different legal structures, so that doesn't really classify all of them, but that's the main idea behind them. And the thing about being private, that they're only available to a select group of rich individuals, is that they're essentially unregulated by the SEC, so they can invest in a much wider range of securities compared to other types of mutual funds. Because of that, they're a lot more risky. They have much higher fees, and they actually perform worse, but that's what they are, and they're essentially unregulated. So they can buy a lot more assets. There was a period around a decade ago again where in certain parts of the market, hedge funds were getting blamed for extreme price movements, and so they got just a lot of press and a lot of attention for a while. That is kind of past now, and they're kind of not quite as popular anymore, and they've kind of shrunk away, and people have lost interest in them. But they kind of come and go in terms of how popular, trendy, or important they are. Where right now they're at a bit of a low point, and a couple of years ago they were at a much higher kind of point with that. These would be the main types of funds. In addition to hedge funds, we could just say we have other types of private funds, and with all this now, there's a bit of a distinction, because when we're talking about funds, we got two levels of securities that we're talking about. So if you take a fund, the owners of a fund, the ones who contribute money to it, the investors in the fund, so they'll own shares of the fund. Exactly what those shares are classified, sometimes those shares are technically common stock in the fund, so the fund's a holding company, and you own stock in the fund, and you own part of the fund. So if you're an investor in the fund, you own shares in that fund, and then what the fund does is the fund buys shares in other securities. So then there's other securities that the fund owns. So when you talk about like ownership in relation to a fund, sometimes it can be confusing if you're talking about the investors who own shares in the fund or the fund which owns other securities. And so the idea is investors, the ones who buy shares in the fund, in a way they could just sometimes directly own these other securities, but usually they get a better deal if they pool their money together, especially if you have securities, the minimum amounts might be in the millions of dollars. Individuals might not be able to buy those securities on their own, but if they pool all their money together through a fund, they can buy those securities through the fund. So you see that investors can buy a lot of securities through a fund that they otherwise couldn't buy on their own. Now when we talk about public or private securities and funds, you could either have you can have securities which are private, like private equity, that is companies that don't issue shares on the stock market. But a fund, because it is an institution, they can buy some of those private securities, like private equity or private types of debt. And then other investors can buy shares in that fund still. Yes?
What does this it say after funds?
What will what be?
What does it say after funds?
Oh, here?
Owns?
Yeah, owns. You can't read that? It doesn't look like a W. The fund owns other securities.
Sorry.
That doesn't look, you're right, it doesn't really look like, that's hard to read.
No, you don't have to, okay.
So the fund owns other securities. And so as far as being public or private, you can have those securities that the fund owns. These can either be public or private. And then also, when investors invest in the fund, you can have funds that are private that only rich individuals can invest in or only other institutions can invest in, or you can have funds that are public. So what we call mutual funds are where the funds are public, basically. Hedge funds are where the funds are private. That's essentially the distinction between those two. And then as far as what they invest in, mutual funds, for the most part, because of U.S. securities law, mutual funds mostly invest in public securities, but it's not a strict relationship. You can have mutual funds invest in private securities also, but for the most part, they're going to invest in public securities. And then for the most part, hedge funds or these other private funds, they can invest in either public or private securities. So there's I guess, a correlation between public funds investing in public securities and private funds investing in private securities, but it's not a very strict distinction. There's a lot of flexibility on that. But it kind of gives you a classification of the different types of funds out there. Any questions about that so far? That all makes sense, right? Okay, so mutual funds, first of all, let's talk about mutual funds. So there's different types of mutual funds. The main type, or the original type. We'll talk first about closed-end funds. So a closed-end fund is just a holding company that owns other securities. And then the closed-end fund, it'll have shares of stock in the fund that trade on the stock exchange. So you want to buy or sell a closed-end fund, you buy or sell the shares of the fund just on the stock exchange, just like you're buying and selling a stock. Because technically the closed-end fund is itself a corporation that owns just other securities. So a closed-end fund doesn't really have that many employees, it doesn't have factories and other stuff. It just owns other securities. And it can own either stocks or bonds or anything else. And that's how it works then. So they're pretty straightforward. Closed-end funds are how the mutual fund business started out. Modern mutual funds were invented really in the 1920s in Boston, and they were all closed-end funds at first. And then they evolved after that, and they became much more popular to have open-end funds. So closed-end funds, generally they don't issue new shares, which is why they're called closed-end. So once a closed-end fund is created, they don't really issue additional shares. Just if you want to buy shares, you buy shares from the other investors. So you have the primary market one time when they basically do an IPO of the closed-end fund, And after that, all the trading is a secondary market. You can buy and sell shares from other investors, but they aren't generally going to be issuing new shares all that much. So most of closed-end funds are actively managed. And what that means is that the fund manager you got a fund manager who's picking securities to buy and sell. It might seem obvious that what the job of a fund manager should be. And again, those securities, they could be stocks or bonds. Usually the fund's rules are going to say whether it's allowed to buy stocks, bonds, or both. And so they'll have them classified together, and they'll have some kind of rule specifying that. But the fund manager can pick those securities, what they want to buy and sell, and they can buy and sell as often as they want to. Now the alternative to that, which you don't have so much in closed-end funds, but with other types of funds, you often have passively managed funds. And those are funds where the fund manager doesn't pick what securities to buy and sell. They just track some index again. So if they have an S&P 500 index fund, they just buy all 500 stocks. The fund manager doesn't really get to pick and choose which stocks to buy. They just buy all 500. And the fund manager's job is just to make sure that it accurately tracks those 500 stocks. Closed-end funds tend to be actively managed. So this is managed. Okay, so that's how closed-end funds work. These, again, used to be popular. Now closed-end funds are going away for the most part. On the assignment, the practice assignment part, what you do is just look at how popular closed-end funds have been over time by going to the ICI fact book and looking at what proportion of U.S. funds were invested with closed-end funds over the last couple of decades. And so that's part of what we get to look at for that. Okay, open-end funds. This was a big revolution in funds because the problem, actually let me go back one more thing about closed-end funds. Sorry. So with closed-end funds, they have what's called NAV. Net asset value. This is the value of the securities that the fund owns. So if you take all the securities owned by the fund and just add up the value of everything the fund owns, that's what we call net asset value. And you do it per share. You can take the total value of all the securities owned by the fund divided by the number of shares, that's NAV per share. So you can have it for the whole fund or per share. And so that gives you one measure of the value of the fund. And then you also have the market price. And then you also have the market price for the shares of the closed-end fund. So if you want to buy or sell shares of the closed-end fund, you buy them in the stock market and you buy them at whatever the market price is that other investors will sell them to you. And the thing is that market price, there's no kind of law or formal mechanism that keeps that market price at all related to the NAV. And the problem with closed-end funds is that they mostly trade at a discount. And so by trading at a discount, what we mean is that that market price is less than the NAV. That's a less than sign. The market price is less than the NAV. In a way, that's kind of a bad deal for investors. So if the closed-end fund owns stocks that are worth $100 per share, when you buy the closed-end fund, you can buy it at a discount. So it only costs you $90 to buy the fund. but it's kind of like the fund is not worth as much as underlying stocks. And so when the stocks go up in value, the fund doesn't necessarily go up as much as the stocks did. So you kind of have this little drag on performance that comes from this discount. And there's a lot of there's no one explanation for why the discount is there. There's a lot of different things. One thing is if you own the funds, you don't get the same voting rights as if you own the stocks directly. Also, sometimes the taxes that you would pay owning the shares through the fund are not as attractive as if you own the shares directly. The fund might not be as liquid as the underlying shares of stock. There's all sorts of little things that go into it. And no one of those things explains it all, but together they kind of add up to an explanation that just for a lot of investors now, it's more attractive to own the stocks directly than it is to own them through the fund. And so you have this discount here. And a lot of times what it means then practically is that if a fund just shut down and liquidated itself and sold all the stocks, it would be worth more than if it continued in business. So if you think of the NAV as being the book value and the market price as being the market value, the market price is less than the book value, which means it's cheaper just to sell the fund and shut it down. For the fund manager, if they just sold all the stocks, they would get more money than if they continued to invest them and trade them. And so this is kind of a problem with closed-end funds. And so the solution to that problem was to create open-end funds. And open-end funds are what dominate the fund business, so it's useful just from a personal finance point of view to know what an open-end fund is and how it works. They're also big players in the financial market. So open-end mutual funds buy and sell, again, a large proportion of securities out there. So they're really big players in the markets. Most of you will most likely have your retirement savings in an open-end fund. The majority of your pension savings and stuff like that. So again, it's useful to know something about them. Open-end fund is also a holding company, just like a closed-end fund. Okay, so securities is what it's going to say. So again, it's also a holding company that owns other securities. But the thing that's different with an open-end fund and a closed-end fund, open-end funds technically are not listed on the stock exchange. Technically, there's not any secondary market for them, so you don't buy and sell shares of open-end funds with other investors. Instead, they have this really unique mechanism that only exists for open-end mutual funds. And the way it works is that every day, the fund will either issue new shares whenever a customer places an order for new shares, so it's kind of like they do a seasoned offering every day, or they will repurchase shares if investors want to sell shares. So you don't ever actually trade open-end funds on the stock market. You don't ever buy and sell them from another investor. It's just every day, again, if you want to buy shares in an open-end fund, what you do is you submit an order. Usually you can either do it through your broker or directly to the fund, like from the fund website. You say, I want to buy however many shares. And what happens is at the end of the day, so this doesn't even happen, you never get shares from an open-end fund when the market's open. It's actually always when the market's closed. So if you want to buy shares, you send an order to buy shares, and at the end of the day, at like 5 o'clock or 4:30 New York time, they have slightly different times as far as when they process it, the fund is going to compute its NAV as of the close of trading that day, and all investors who want shares, they get shares, new shares issued to them at the end of the day, at whatever the closing net asset value is. So you don't have any market price, you get exactly the NAV. So go to the fund at and the price you get is always going to be that end of day net asset value. So you don't have a market price, you don't have a bid-ask spread or any of these other things. You always get shares at exactly that net asset value. And that net asset value is the daily closing price of all the securities owned by the fund. And if you want to sell shares, you don't actually sell them to another investor. It's just you submit that order to the fund, and at the end of the day, basically the fund takes your shares back and they'll give you however much cash the NAV of all your shares is. And so you only ever transact with the fund directly when you buy or sell shares in an open-end fund. It's a really weird, unique kind of way to buy and sell shares. It doesn't happen for any other security. That doesn't happen for stocks, bonds, or anything else. It's only these open-end funds that work this way. Again, it's kind of like they're doing not an IPO, but a seasoned offering every day, and then they're repurchasing every day directly from investors. And so that's how an open-end fund works. And so what that means is you have no market price, so there's no discount because there's only the net asset value. And because of that, the number of shares is going to change every day because it's issuing new shares and repurchasing new shares. And so investor demand determines whether they're buying shares or selling shares. And that's going to change the number of shares that are out there for these funds every day. And then when investors buy and sell shares in the fund, then the fund manager is going to go usually a couple days later, like a week later, and then they're going to buy or sell the underlying securities, the stocks or the bonds, whatever it is that the fund owns. And so that's how an open-end fund works. So it's a little bit different than a closed-end fund. Any questions about that? Okay, an exchange-traded fund then is the next type. So an exchange-traded fund or an ETF, we looked at these in the last chapters. It's kind of a mix between the two. So it's like a closed-end fund because its shares trade on the stock market. And so the thing is, like, if your shares trade on the stock market, then you can buy and sell shares at any time of the day because whenever the stock market's open, you can buy and sell shares. With an open-end fund, you can't buy and sell in the middle of the day. You only got this once a day at the end of the day when everybody's transactions are done for an open-end fund. So a lot of investors, especially if they're active traders, they don't want to wait and just trade once a day at the end of the day with an open-end fund. They want to buy and sell hour to hour throughout the day. And so to do that, you need either a closed-end fund or you need an exchange-traded fund. So it works like a closed-end fund because it's traded on the stock market throughout the day. But whenever your NAV gets different, so whenever it diverges from the market price, then the ETF's either going to issue new shares or they're going to repurchase shares. So if you start getting a discount, then the ETF is going to start repurchasing those shares. And they'll repurchase them at that lower price, and that'll force the market price to come back to the right level. And if the market price is too high, then they'll just issue new shares. And basically investors can do this on their own. So if you got an ETF and the market price is too high, what you can do is you can buy the shares of the underlying stock, like an institution could do this, and you present it to the fund and they'll give you shares of the ETF if you give them the underlying stock. Or if you're a big institution, instead of selling your shares of the ETF, you can tell them just to give you the underlying stock or securities instead, and they will. What it does is it just forces that market price to stay where it's supposed to be at the NAV. So it gets rid of the problem you have with closed-end funds, that the NAV and the market price are different. With ETFs, those are going to stay the same pretty much. ETFs, they're fairly new, and in part of the assignment, we'll look at how much they've grown recently. So they started in the 1990s, although they really got big, only say the last 10 years. And they're one of the fastest growing types of funds. So they're really popular now. They're growing very quickly, and they've been growing very quickly over the last decade. They're not nearly as big as open-end funds, but they're definitely more of them than there are closed-end funds now. And on the assignment, we'll see exactly how they've grown and changed as far as taking market share over time. One thing about ETFs, is that ETFs are all index funds. Which means they're passively managed, so they're not actively managed. So again, closed-end funds and open-end funds, they can either be passively managed or actively managed. With actively managed, you have a fund manager actually picking stocks to buy and sell. Passively managed means it just tracks some index, and the fund manager doesn't get to pick, they're just there to buy all the stocks in the index for the most part. ETFs, because of the way this mechanism works for them to issue shares and repurchase shares, the only way that really works well is as an investor, you have to know what the shares are that it owns, but if the fund manager is always buying and selling shares, you don't really know what it owns. So the only way for that to really work efficiently is if they track some index so you know exactly what they're supposed to own all the time. That way you can judge whether the NAV and the market price are really diverging from each other or not. So these are all going to be passively managed, at least in the US. There's plans to have actively managed ones, but that's really kind of new, and it's really unclear how that's going to work yet. So far, they are pretty much all passively managed. Any questions about those? Yes.
What is the best kind of funds? Is it the ETFs? That's what it sounds like.
As far as the
Like,
best? Well,
yeah,
they all have their trade-offs. Closed-end funds are probably not best in any way now, which is why they're kind of going extinct. If you're a buy and hold investor saving for retirement, open-end fund might be the best because it has low transaction costs. The problem, it also has low liquidity, so you can't buy and sell it during the day, and you have to pay fees to the fund manager. ETFs are the most efficient if you demand liquidity, so if you want to be able to buy and sell a fund quickly, like during the day, then ETFs are definitely better than open-end funds. But then you're limited to these index funds. So if you want something actively managed, ETF's not an option. You can't, it doesn't exist for that. And if you want liquidity, then open-end funds are not really an option. So it depends exactly what you need. So for certain purposes, ETFs are better. Other purposes, open-end funds are better. And so there's kind of an equilibrium. We have both of them there. Open-end funds for certain purposes and ETFs for other purposes. Now, another security we have, which is really popular now, and one of the fastest growing actually, is not a fund at all, but we should probably mention it here because most investors and most people who work in the market think these are funds, but they're not. They're basically fake ETFs. They're called exchange-traded notes, and we looked at these with the last chapters. What these are. So you'll see exchange-traded notes or ETNs. What they are is they're actually floating rate bonds that mimic ETFs. So they try to copy ETFs. They try to appear as if it's an ETF, but it's not really, because it's not a fund at all. But they're listed as funds. So if you look at the Wall Street Journal or any other fund kind of reporting source, they'll list these exchange-traded notes along with the ETFs because they kind of appear identical for an investor. But the thing is, these are not funds at all. Exchange-traded note is just a floating rate bond. So it's a bond, but the value of the bond, both the principal and the interest, are just tied to some index. So it tracks an index just like an ETF, but there's actually no holding company, there's no underlying holdings, there's no fund manager. The ETN doesn't actually own any securities. It doesn't have a NAV like an ETF. It's just the value of the bond is tied to some index. But what that does is there's certain indexes out there that investors would like a fund to track, but it's actually not possible to track because it might be an index that is, say, in another country where you can't actually buy the securities, or it could be a kind of artificial mathematical index that where you can't actually buy the underlying securities. So exchange-traded notes could track those where an ETF could not, or an ETF would have a lot of trouble. Or it could be securities that just have really high transaction costs. And so you wouldn't actually want to own the underlying securities because they're really expensive to trade, but the ETN could still track their value. And so these are really popular, but they're actually not funds, even though most people probably think they are. And so you'll see these along with those. A lot of times you'll see the thing about ETNs is even though they're bonds, they're traded on the stock market. So they trade as if they were a stock, when actually they're a bond, and they appear to be a fund. So they're kind of confusing from three senses. It's a bond that trades like a stock, but pretends to be a fund. It's kind of a weird thing. But if you look at the most popular securities traded, so if you look at the most widely traded security on any given day, and these are pretty new, for the last like year or two, most of the time the most popular security traded is going to be an ETN out there. So it's not going to be a big stock or something else, it's going to be an exchange traded note that's most popular out there. So a lot of times you'll see these listed as exchange traded products, which is just ETFs and ETNs. So now you see both of them kind of listed together as ETPs, and that's what it's talking about. Just these exchange traded funds and exchange traded notes together. Questions about those? Okay, so you've got those. And then these other ones, these unit. Unit investment trusts. These are like a special type of closed-end fund, but they're the ones that are not actively managed. So the way a unit works, in case you ever encounter one of these, sometimes they're popular for like life insurance companies to invest in. It's like a closed-end fund, so you can buy and sell in the stock market, but there's no fund manager. What they do is when they're created, they invest in a certain set of stocks, so they'll have like a list of whatever, 50 stocks or something they're going to pick. They invest in those 50 stocks, and then they just buy and hold those. They just keep that same portfolio of 50 stocks for say like a 10-year period of time, and their value will just track those 50 stocks. The fund manager doesn't buy and hold, doesn't trade any of those stocks, they just hold them. And then at the end of the 10-year period of time, they basically sell all those stocks and they cash out the money and they pay the investors. So that's all they are, and you'll see them listed, really, they're pretty obscure, so you don't see them all that often, but that's the idea behind them. That's those trusts. Another type of fund, which is a lot more popular, are REITs or rights. Sometimes they're pronounced either way. They're real estate investment trusts. And these are like a closed-end fund, but instead of buying other securities, they buy real estate. And this is actually now one of the most popular ways to invest in real estate. So if you want to invest in real estate, but you don't want to have the risk of being exposed to just a single property, or you don't have a big enough pot of money to buy an entire property, especially if you want to invest in something like commercial property, which starts out in the millions of dollars. There are funds that invest in real estate. So you can buy these real estate investment trusts or just a share in them. You can buy pretty small amounts. And they'll invest in different types of real estate. And you can have ones that invest in residential or commercial, domestic, foreign. They can be diversified across all different kinds of real estate. They can be regional. They can be everywhere. So this is one of the most popular ways to invest in real estate is through these real estate investment trusts. And actually a very large amount of real estate, especially when you get like commercial real estate, is actually owned by these types of funds now. So especially if you look at apartment buildings and hotels, a very large proportion of them are owned by these real estate investment trusts. Also stuff like retail, like stores and shopping centers, especially malls. These are really the main way that those types of properties are owned now. And then regular people invest in them through them being offered like a fund. Questions about any of those so far? Okay, so hedge funds are also funds. So a hedge fund is going to work a bit differently from those other funds. So hedge funds are not going to be traded in markets, so you can't buy or sell shares of a hedge fund. At least for most hedge funds, you can't. So what you do is if you're either a rich individual or you're an institution, you just have an account directly with the fund manager, so you don't buy or sell the fund. And then that fund manager is going to invest your money along with whoever else is in the fund, and they're going to trade in the markets buying and selling securities. So the thing about hedge funds is that they're essentially unregulated compared to mutual funds. So with mutual funds, because anybody can buy shares in a mutual fund, they're heavily regulated by the SEC. And so let's look at that. So the Securities and Exchange Commission, they heavily regulate mutual funds, especially open-end funds, but also closed-end funds and ETFs. And basically what they do is they have lots of disclosure requirements that the fund manager has to publish everything they buy and sell or everything they own at certain points in time. They have to publish lots of information about the fund as far as the fees, the governance, how the fund works, how the fund manager is paid. All that kind of stuff has to be disclosed. That's probably the main way they're regulated. And so there's restrictions on how risky the fund can be and what securities they can hold. The main thing is the funds generally, they cannot have much leverage and they can't own much derivatives. So they can own stocks, they can own bonds, they can own domestic or foreign, but not very much derivatives and no real leverage. They can't have leverage or derivatives for the most part. So they can't have leverage or own derivatives. Importantly, though, there's no guarantee, though. So the SEC gives no guarantees of the mutual fund industry, and to date, mutual funds have never been bailed out in any way by the government. So it's pretty clear that there is no government guarantee and no government protection for investors in mutual funds, either open-end, closed-end, or exchange-traded funds. They've never been bailed out. There's never been a consideration of bailing them out, no matter what kind of trouble any of them got into, and investors have never expected any kind of bailout. So it's clear that there's no, with the exception of one type of fund, so it's clear that there's no real government guarantee, even though they're heavily regulated by the government. Now, compared to hedge funds are essentially unregulated. They can invest in anything they want, especially with leverage and in derivatives, and they do invest a lot with leverage and in derivatives, and they don't have to disclose stuff. They're unregulated, and they can be very secretive. They don't have to publish what they invest in. They don't have to say how the managers get paid. They don't have to say how their governance works as far as who has control of the fund. They don't have to disclose any of that. So they're very secretive and they're essentially unregulated. And because they're secretive and unregulated, that's why, again, regulators and politicians sometimes find them to be very scary and easy to make them the bad guys in the financial markets and stuff like that, because they're unregulated and secretive and they're owned by a bunch of rich people. So they make attractive bad guys. Any questions about all that so far? All right, one other thing that appears like a fund. Was there a question? Oh, sorry. Am I ignoring your questions?
No, it's fine. Do they have like boards, just like any other? Like,
Yes,
company
we'll look
discount?
at the whole structure of them. Actually, right now is a good point to look at. The structure of funds is actually kind of complicated. They do have a board of directors that governs the fund. So you have shareholders in the fund, and the shareholders elect the board of directors. Actually, they're referred to usually as trustees. Sometimes directors, sometimes trustees. So board of directors are a board of trustees who don't actually work for the fund, but who are employed by the shareholders to manage the fund. And then they hire a couple different people. They hire an outside firm, actually, called an investment advisor. So they make a contract with an outside firm as an investment advisor, and the investment advisor basically supplies the fund manager. So it's kind of weird. The fund manager actually doesn't work for the fund. The investment advisor / fund manager is actually like a third-party private contractor who basically gets hired to manage the fund, but who doesn't actually work for the fund. So it's like a separate outside contract. Actually, the fund itself doesn't have any employees. All the fund does is it owns these securities, and then you have this. It's really kind of weird the way it all works. And it's relevant in the sense that if you work in the financial industry, you'll encounter these different types of firms that don't call themselves a fund, but they do all the work for the fund. So if you want to work for a mutual fund, you don't actually work for the fund. You either work for an investment advisory firm, or you work for one of these other firms here that's connected with the fund. So you have them. And then they also make a contract with another firm called a transfer agent. And their job will to do sort of the daily operations of the fund and to process everything. So like the people who do the accounting for the fund, who basically when shareholders want to buy shares, they send in money, and then they get a receipt saying they own the shares. All that's done by another firm called a transfer agent. And the transfer agent will handle all this kind of day-to-day operations and processing. And then in addition to those, you'll have another one you'll have a broker. Actually, that says broker, where that misses. You'll actually have more than one broker. You can have many firms that act as brokers, and their job is to sell the fund to investors. So they're just like the retail salespeople for the fund, and there can be many different brokers for any given fund. So you got kind of a weird structure, and you got these different people that are kind of affiliated with the fund, and then the other thing you have. Yet another person. You have what's called the sponsor. Or the fund family. And this is kind of is the brand name on the fund. So funds are usually given like a brand, like Fidelity, Vanguard, Columbia, T. Rowe Price. And this will be a fund family, and they kind of provide, in a way, it's like a franchise almost. They don't necessarily supply the investment advisor, although usually the investment advisor is affiliated with them, but they provide kind of the name of the fund, and they provide like a set of laws and policies that the fund's going to follow. So all the kind of investment strategy and a lot of the marketing and stuff, it'll come from that fund family, and it's almost like a franchise type thing. So you got the fund family that provides the overall kind of rules and the setup for the fund. You got the fund manager, who might be like the franchise owner, but the franchise manager, I guess, because they don't really own it. You got the transfer agent who processes everything. You got brokers who sell the fund. And the fund itself, actually the only employee that the fund itself has is every fund has one lawyer who works for it, and the lawyer just coordinates everything with this. And that's the only actual employee of the fund itself. So it's kind of a weird, complicated structure, but if you ever work in the fund industry, or if you are going to deal with the fund industry, you'll quickly have to figure out all these different parts of it. And so when you see these different kind of parts out there in the financial system, they're all different parts of the mutual fund business. Questions about that? Did that answer your question? That was what you were asking about. I spent many years working as an investment advisor for one of the main mutual fund companies, which isn't really giving any kind of advice, but it's working for a fund manager who buys and sells stocks for a fund. Stocks or bonds or whatever other securities there might be. So that's kind of and that applies really for any type of fund, but it's most apparent for the open-end funds, because the open-end funds, they have the most going on with this. Like with closed-end funds and stuff, because you kind of form the fund structure when it's issued, and then you don't have to do a lot more with it after that, because you don't need as much processing with a closed-end fund, because you're not have and redeeming shares all the time, it doesn't make as much difference all this. So it's mostly with open-end funds that this matters for the most part. Something else that works like a fund is you'll see something called separate accounts, is what it says, separate accounts. And what separate accounts are, these are like internal mutual funds that are managed by either insurance companies or other asset management companies. And usually what they do is they will have the same fund manager basically manage one version of the fund in-house, and then the identical same fund, because if the fund manager is doing it internally, it makes sense for them also to let outside people come and get the same investment advice for a fee. So they'll run the funds internally, and then they'll also offer them to external investors, the same fund with the same name, run by the same fund manager. And this is mostly important because sometimes if you see a mutual fund buying or selling, say, shares of a stock, there might be just as much or more shares of that stock being bought and sold by a separate account under sort of an internal type of fund. And the thing is, like, insurance companies, they invest a lot of money, but they want to say buy it through mutual funds. They'll have these internal mutual funds that run like alongside another type of mutual fund. So you'll see this if you deal with Again, the financial industry, you'll see this a lot, working in the industry, and it's not always clear what they are, but they're basically internal mutual funds run by insurance companies or asset managers. And you can't buy them as an outside investor, but if you have an account with the insurance company, it's probably invested through one of these types of funds. Make sense? Yes, it does. So you have those. One other type of mutual, these are all the different types of mutual funds you encounter. One other type that you'll see, which we mentioned a little bit before, money market mutual funds. So MMMFs, money market mutual funds. These are a special type of open-end fund. And like the name implies, they just invest in money market securities. And the other thing that's special about them, they also have a special way that they do their open-end structure. So if open-end funds sound complicated, the way they issue and redeem shares every day, money market funds even modify that a little bit more. So they always keep their NAV equal to exactly $1. So the way that works is they just invest in money market securities, which are supposed to be really safe because they're these short-term securities like treasury bills and stuff. And basically they always keep the net asset value at $1. If they ever earn any extra money above $1, they pay it out to their investors as interest. So it basically ends up being like a savings account, which is exactly what they were intended to be. They were intended to compete with bank savings accounts. But instead of being just held by a bank, because they invest in whatever money market securities they think are best, either treasury bills or commercial paper or something like that, whenever they earn interest on those securities, they pay it out as interest on the account. So it's essentially like a savings account. If you buy $100 worth of shares, then you have an account worth $100, and they keep that NAV always at $1. So if you buy $100, your account's always worth $100, but then they pay you interest on it. So you have like a savings account that you earn interest on. That's the idea behind it. And so whatever the fund earns, it's paid out to investors like interest. So it's like when you earn interest on a bank account. Now, these types of funds, they were invented because, there used to be regulations on the interest that bank accounts could pay, and it made bank accounts very unattractive as investments back in the 1980s, when the interest rate that you could earn, actually when the rate you could pay on your bank savings account was less than the inflation rate, like in 1979, 1980, 1981. There's like an upper limit banks were allowed to pay on savings accounts, somewhere around 10%, and the inflation rate was like 11 or 12%. So you'd actually lose money, you'd have a negative effective interest rate, negative real rate when you had a savings account. So these open-end money market mutual funds kind of were invented and said you could put your money in this mutual fund and you'll get whatever interest it earns. And since inflation was like 12%, treasury bills were paying like 15, 16%. So you could make a lot more money by investing in treasury bills. But back then it was really hard for an individual to invest in treasury bills directly because they didn't have that Treasury Direct website or anything. So you could invest in these money market mutual funds and you could get that rate of interest. And they were really liquid accounts, so you could get your money back at any time on these. So it was like a savings account, but you got more interest on it. You still earn a little bit more interest on these than you would in a regular bank savings account, so they're still attractive. And a lot of times if you have, like, say, a brokerage account, like an account where you buy and sell stocks and you have some cash left, usually it'll be put into a money market mutual fund, so you'll earn money that way. And if you're any kind of business and you keep a large cash balance, usually this is what it'll be invested in. And so these are really big investors in the money market. So most trading in the money market is actually done by these kind of funds. And that's the way it works. And I was saying a minute ago that no mutual funds are being bailed out by the government, or have been. The one exception is with these money market funds, because the thing is you get a little bit more interest on these accounts than you would in a bank account. And kind of the reason for it, or what goes along with it, is that these are riskier than a bank account. A bank account you can never lose money on because they're always insured by the government through the FDIC. Money market mutual funds are not insured. So in theory, if they invested in treasury bills and the treasury bills lost money, you could lose money on these accounts. Treasury bills never lose money though, so you couldn't do it on treasury bills. But if these invested in commercial paper and that commercial paper defaulted, then you could lose money on these money market mutual funds. It was always assumed to be so rare it would never happen, but in 2007 and 2008, there were some of these money market mutual funds that invested in commercial paper issued by banks like Lehman Brothers and Bear Stearns that we'll look at more, that went bankrupt. And so some of the money market mutual funds were going to lose a little bit of money. And it was actually a big panic because everybody thought these funds were really safe. And so like it was a Friday afternoon in 2008, I think, when Lehman Brothers went bankrupt. And then by Sunday morning, everybody figured out that the money market mutual funds were going to lose money because they invested in Lehman Brothers commercial paper. So on Sunday afternoon, there was kind of this big panic that what were we going to do about that? There's like lots of different businesses that had their cash balances in money market mutual funds, and they needed that cash to pay salaries and stuff. And so there was a big panic about what to do about it. So the Federal Reserve Bank in New York decided on Sunday evening that they were going to guarantee or basically bail out these money market mutual funds. And so they said, if you have money in a money market mutual fund, it's going to be guaranteed. We'll make sure you won't lose any money on it. And so that seemed to solve the problem. But then, so this was on a weekend. And then it was like 2 o'clock in the morning Sunday night that somebody in the Federal Reserve woke up and thought, if we guarantee money market mutual funds and they pay higher interest than commercial bank accounts, then on Monday morning when the market's open, every large business is going to close their commercial bank account and move all that money to money market funds. So they'll make more money that way. But that means every bank in the country will essentially have a run on it, and the whole banking system will blow up and explode. So they had to backtrack at like 4 in the morning on that Monday morning, just before like all chaos was going to be unleashed in the markets, and essentially cancel their guarantee. And so it was like the whole financial system almost imploded because of all of this. But somebody figured it out like an hour before the markets opened, and they kind of solved the problem. It was like one of those big disasters that could have been and almost happened but didn't. But that was the only almost bailout of the money market mutual fund industry. It was a neat story that almost happened but didn't quite unfold the way people thought it could have. But it shows that they weren't really thinking all the way ahead with some of that stuff. It was a panic and it was chaos and nobody really knew what was going on back then. That was the fun times of 2008.
The glory days.
Yeah, back before most of you were born. But it was back in the old times before the whole system changed. Okay, what next about these? Those are the different kinds of funds that we have for the most part. With money market mutual funds being, again, a variation on open-end funds. What we want to do next with it is, this here. Let me give you a preview. The next part to start, we won't be able to get through it all right now anyway, so rather than starting the next little section, what I wanted to look at with these, let me just give you a preview of the assignment.
We can do that next class, I think.
Oh my God.
We'll do it quickly, just to look at what we're going to have here.
Can you do it for us? I mean,
Do the assignment. I'll do the practice assignment for you.
no, the actual one.
And I'll post the solutions. So what you have on the next, no, this isn't the right one, this is chapter 1. You already
Wrong
had that.
chapter.
Yeah, we had that one already.
See, now you have to do it for us. I helped you present the paper.
I was about to give you assignment 1 again, the first one. Okay, so here's what we have. On Yahoo Finance, there's a fund screener that allows you to basically search through all the different funds that are traded in the U.S. And you can search through by a bunch of different ways. If you use that screener, we'll look at it next time. You can sort funds by their return, by all different types of measurements of their return, like their monthly return, their annual return, their year-to-date return, their 3-month return. So, and you can also sort them by their investment category and their size. Mm-hmm.
The date's wrong, I don't think Wednesday is the 20th.
Is it not?
No?
Yeah, it is.
Yes, it is.
Well, I thought it's the 23rd today.
Today is the
Okay,
22nd.
never mind.
No, good point though, good try. I don't know what it's called.
It's okay, I did my best. Do I get a certificate for it? Or
The fund screener, so you can sort and you can, actually the fund screener is really useful just from a personal finance point of view because again, most of you are eventually going to have your retirement savings in some type of mutual fund, so it's useful to know where to go to find information on them. That fund screener, even though it's just Yahoo Finance, it's a useful way because it has pretty much all the funds in the US listed there. And you can sort them by whatever way you want to do, especially sort it by expenses, by size, by returns, by all that stuff. So what I want you to do is I want you to find the largest US mutual fund that's listed on there by total net assets, copy and paste the quote, and then also see what you can find about that same fund in the Wall Street Journal. It may or may not be listed on your day of the Wall Street Journal because the Wall Street Journal doesn't list all funds, it just lists the largest and most popular ones. If it's not listed for your day, say it's not listed, but I'll check and make sure it was actually not listed that day. So to give the kind of quoted information you get in the Wall Street Journal for it. Then there's also an exchange-traded fund section of Yahoo Finance, which actually is exchange-traded products that includes both exchange-traded funds and exchange-traded notes. And find the largest U.S. exchange-traded fund. And then again, copy and paste the quote, and then also give the information for that same one from the Wall Street Journal. And I did something very similar on the practice assignment. Instead of looking at the largest ones by size, I looked at the ones that had the highest returns and the lowest returns on the practice assignment. So you can use the screener the same way. In number 5, there is the fact book from the ICI, the Investment Company Institute. This is actually like the Washington lobbying organization for the mutual fund industry, but they put together really good data and facts about the whole fund industry. Their fact book is actually a great way to learn about mutual funds. They have all the kind of different information and statistics and neat little trivia about the fund industry. But basically using that fact book, and you can download everything in it into Excel, and it's really easy then just to make a couple graphs summarizing some of this information, especially about how many closed-end funds there are in terms of the total assets invested in them, what proportion is invested in closed-end funds, and then what proportion is invested in index funds. And all that information is given somewhere in that fact book. So you need to browse through that fact book a little bit. I want you to actually browse through it for a couple minutes to see some of the stuff in it. And that's what we have for number 5 there. And now number 6, what we're going to start looking at next time. And this is where we're really going to kind of transition from looking at financial markets that we've had up to now to looking at institutions. At the institution level, we want to more look at the actual individual companies. And usually when we look at an individual company, we're not looking at quotes for the securities traded out there in the markets, but looking at the individual companies, we want to look at their financial statements. So a lot of what we have for the rest of the semester is looking at the financial statements of individual financial institutions. And some of these institutions, we're going to look at them for the rest of the semester. So it's going to be go ahead and find their financial statement, that is their annual report, download it, read the whole thing now if you want. They're usually about 250 pages, so you don't need to read the whole thing yet. But at least find their income statement and balance sheet because we'll use those repeatedly. JP Morgan Chase is going to be a good example. It's the biggest bank in the U.S., so we're going to use it several times. Also, there's a company, Allianz, a German insurance and universal bank, BlackRock, which is an asset manager, and State Street, which is an asset management and commercial bank in the U.S. To find them, find how much they manage, and by assets under management, it basically means running mutual funds and other types of funds for their clients, and basically finding how much they manage and ranking them by those amounts. We're going to be looking at that as we go. Then there's a news article posted in there, basically to read that, and it's about one of the types of funds that we've mentioned here, and about some of the trouble that one of these companies ran into with issuing and redeeming shares of one of these funds. It kind of walks you a little bit through this whole process of issuing and redeeming shares in a fund. And so we'll have that, and that's what the last part's here about, and then finding some quotes related to that. Questions about it? We'll get to see this more. We have, this is not due until, again, a week from Wednesday, so you have a week and a half still for this assignment. Okay, I'll see you next time then.